I think the stock market's going to keep going down. I think we kind of hit, we really stopped the economy very abruptly. This tariff thing is a shock. Even if tomorrow he comes back and says, hey, we're just kidding, we're not going to do any of those tariffs, the damage has been done. I mean, it's, the economy is slowing and we were in a bubble. So bubbles don't deflate gradually. I think the stock market will be going down, will be significantly lower by the end of this year. I think the effect of that will be unemployment will be up and tax revenue will be down and unemployment insurance will be up. So the whole notion of the budget deficit getting better, no, I don't think it's going to get worse. It was 1.8 last year. It's running at 2.3. Doge is only going to save 150 of that, if that. I mean, I think we're going to have a budget deficit of, well over 2, maybe 2.5, maybe even 3 trillion. So that's not helping.
The stock market's recent stumble isn't just a temporary dip. It might be the first tremor of a much larger quake. After years of soaring prices, cheap money, and speculative frenzy, reality is finally knocking at the door. The economy, once racing ahead, has slammed into a wall. Trade wars, policy whipsaws, and fading consumer confidence have left businesses hesitant and investors nervous. Even if tariffs vanish overnight, the psychological blow has already landed. Bubbles don't deflate quietly, they burst, and when they do, the mess is never small. Larry Lepard, a sharp-eyed market veteran, sees trouble ahead. He warns that stocks could keep sliding. The abrupt economic slowdown, amplified by trade shocks, is already rippling through jobs and budgets. Unemployment is creeping up, tax revenues are drying up, and deficit projections, already staggering, are set to explode past $3 trillion. What was supposed to be a soft landing is starting to look like a nosedive. The Fed's toolkit might buy time, but it won't stop the reckoning. For investors banking on a quick rebound, the message is clear. Hope isn't a strategy. The storm clouds are gathering, and this time, there's no easy escape. Let's watch clips from Larry Lepard's explosive interview to gain more insight. Don't forget to like, subscribe, and enable notifications for additional in-depth content. Thanks for joining us again. Enjoy the video.
It's kind of a myth that they've set up. The system is rigged against the average person. And, they've done that because they bought into the Keynesian notion that you have to have animal spirits and inflation to keep the economy going. And if you don't have those things, you might fall into a deflationary trap and we're going to repeat the Great Depression. I mean, that's the Great Depression is kind of the Keynesian boogeyman, right? Anytime that, prices fall, oh no, we've got deflation, we're going into the Great Depression, which is just absurd on its face because history shows that there were plenty of periods of deflation in the 19th century and even early in the 20th century. And during those periods, the economy did fine. People did fine. Living standards got better. The Fed has set up they bought this Keynesian lie and they propagated it and they've set up a system where they benefit, financial players benefit, and the governments benefit as long as there's inflation. And they scare us by saying, boo, there's going to be deflation. Therefore, you got to allow us to print. And of course, what that does is that gives the unfair advantage to all those who are closest to the printer, the people that we all refer to as quintillionaires. And, that's just the system as it is. And what it's led to is the chart in the saddest chart in the book, or one of the saddest charts in the book, which shows that the top 1% have 92% of the wealth in this country. And that's because the top 1% have figured out how to game inflation, how to, get rich on inflation. Inflation hurts the average person because they pay higher prices. Their wages don't go up quickly enough to cover them. But the person at the top knows how to make inflation work in their advantage. That we are in a bubble right now, the everything bubble, and that curing that would create a deflationary collapse if we were to allow all the natural prices to occur. The thing that's going to happen is that they're not going to allow that to happen naturally. I mean, and this, by the way, this should have started years and years ago. It should have happened in 2000. It should have happened in 2008, et cetera, et cetera. We've never had, an economy that has properly corrected since we went off the gold standard, really. Although, it kind of did in the earlier 70s and 80s. But the prices right now are all unreal, and that's because all of these things have monetary premium in them, houses, etc. What will happen, And you can say, well, we've got to have this inflation because of all this debt, and they're correct about that. But I would say, how do we get all the debt to begin with? We got all the debt because of the inflation, and people needed to use debt to try and create growth. So, in a system of sound money, which is what I advocate for and what all Bitcoiners advocate for, we wouldn't have nearly as much debt. Because debt would be a dangerous thing, because you'd be paying back whatever debt you took on in money that was worth more, not worth less. And so, in fact, most of the financings, I think, in the sound money system, and this is actually how it kind of was in the 1800s. There were bonds then, but not as many. And a lot of things were financed just with equity financing. You wanted to build a business, fine, you raise capital in the form of stock, and if the company does well, it earns profits, and if those profits are good, they pay dividends. And so that, we'd see a lot more of that and a lot less of things getting incredibly levered in order to try and squeeze the last ounce of growth out of a particular situation. If we were to sell all our gold today and buy Bitcoin, that would certainly help things. I mean, it's hard to tell, to be honest, Mason, whether we are too little, too late on the monetary system. I mean, I think that Andrew Hohn's proposed, doing Bitcoin bonds where the government would issue debt and use some of that debt issuance to buy Bitcoin and then reward the bondholder with some of the upside in Bitcoin. I think that would be a good idea. I think that would help defease the debt. I think that if the government were to ultimately transition to a Bitcoin standard, well, the effect of that would be the value of the dollar would go down quite a bit. And if the value of the dollar went down quite a bit in Bitcoin terms, then the debt wouldn't be such a burden. I mean, the problem we really have is the debt is incredibly large as compared to the underlying GDP. And so those two things need to be reset. And either the GDP needs to grow a lot, and you can do that with high inflation, or the debt needs to be reduced in size, and you can do that by either having it default or collapse. And probably the likely outcome is some combination of the two. Some of these debts are going to fail, and there's going to be inflation to grow the GDP. So that's how we get back to a balanced system. But as you allude to, this is going to be messy. There's no easy way out. What happened on, I think it was April 7th and 8th, was really kind of shocking, right? I mean, the market rolled over hard, went through 5,000. Initially, Besant got what he wanted. The 10-year yield went down into the 380 range. And so everybody thought, oh, this works. If they put on tariffs, hammer the stock market, get a bid in the bond market, it's all good, right? And then a couple days later, the bond market started to slide hard, and we went from 380 to 450 or 60, I think it was, in a very short period of time. And I'm sure alarm bells were going off, because you can't have the Treasury bond market malfunction. And I think my guess is what happened is Besant went to Trump and said, sir, we're losing the bond market. You got to basically delay these tariffs for 90 days. And so he did. And after telling everybody who was his friend that he was about to do that, so that they could load up on call options, he did reverse the tariffs for 90 days. And we had the largest one-day rally in quite some time. And now the bonds have settled down. So, yeah, I mean, of all the things I look at, the price of gold, the price of Bitcoin, the price of silver, the stock market, I think the bond market's probably the most important one, and the one that really creates a problem, because the government has to roll over $7 to $10 trillion of debt every year. And so that interest cost is a huge line item now in the federal budget. And, if the bond market starts to fall apart, they really only have one tool, which is to buy it themselves via quantitative easing. I mean, they can try to get the banks to buy it. They could change the SLR, supplementary leverage ratio, which allows the banks to buy more of it. They could maybe issue swap lines to the large hedge funds. They've talked about doing that. There was a Brookings paper that said maybe we should have preemptive swap lines. But the problem they're encountering is, as you alluded to, Mason, it's kind of a third world problem. And it hasn't really happened before, except we've seen it in the third world, which is the following. The stock market's going down, the bond market's falling, and so rates are going up, and the currency's falling. All three of those things, those are what happen in developing markets that have inflation and currency issues. And so we are now seeing those three things happen in the largest, country in the world with a neutral reserve currency. I mean, that's not supposed to happen. Stocks are supposed to go down. There's supposed to be a bid for bonds because they're safe. We're not seeing that. The other thing that I would point out that's happened that's very interesting, as you guys I'm sure are aware of, is the decoupling. That here we are and we have stock markets down for the year, and yet we've got, well, gold is going up like a rocket, and Bitcoin has got a nice bid. I mean, since that 8th or ninth date, Bitcoin is net up, and the stock market is actually down. We had that big rally. I think it was on the ninth or 10th, and the stock market's down from the peak of that rally. Bitcoin's up from the point it was at that time. So that's another positive trend for those who used to think that, well, Bitcoin's just a proxy for the triple Q. And I think that's because people are coming to realize that it has a safe haven component in the fact that you can't print it.
Yeah, and obviously less affected by tariffs and a trade war.
Well, that's right too. Yeah, it's kind of outside of the system, right? It's kind of hard to tariff Bitcoin or Bitcoin payments. Yeah, it's a good point.
The Fed's fear-mongering about deflation is a scam. History proves falling prices don't doom economies. They empower workers. Yet today's rigged system pumps endless cash to Wall Street, inflating assets while wages lag. The result? The 1% hoard 92% of wealth. Now the debt bubble's bursting. Bonds wobble, stocks sink, and even the dollar weakens. Bitcoin and gold are rising as escapes from this mess. The truth is, inflation isn't policy, it's theft. Time to wake up. The Fed's money printing orgy created history's greatest bubble. $5 trillion printed, rates at zero, fake wealth everywhere. Now the avalanche starts. Gold rockets, bonds quake, deficits explode. The $37 trillion debt monster can't be fed. When bond markets rebel, the Fed will print into hyperinflation. Your dollars are losing value. The solution? Hard assets like Bitcoin or gold. The system is collapsing due to its own corruption. You have a choice. Hold on to worthless currency or wake up and take action. Let's watch more clips from the interview.
I do believe we are in a bubble, the everything bubble, driven by the COVID print of $5 trillion and 40% money supply growth and 0% interest rates from 19 to 22. So I think, that created a bubble in absolutely everything, and the bubble has popped. Another analogy I would use earlier, people were talking to somebody else about the price of gold and how suddenly it's just moving in an uncontrolled manner in one direction. And I said, well, it's kind of like an avalanche. I mean, and the snow kept building up and building up and building up, the imbalance between the value of gold and the amount of money outstanding. But everyone trusted the money, so gold really wasn't moving that quickly. Well, now we finally got the last snowflake and the avalanche broke loose, and it's got to go to its natural conclusion. So I think there's some of that. I think the can is a very good one as a metaphor for what the government is trying to do, and the can is getting larger and harder to kick because of the math of the situation. The deficits are larger. Interest cost is now running at 1.2, 1.3 trillion. It's bigger than defense. And with each of these, I wrote the book, I titled it The Big Print. This is really, it talks about what I think is the coming big print, but we've actually already had two big prints, right? We had one in 2020 and we had one in 2008. And of course, 2020 was bigger and happened faster. '08, Bernanke took us from a 900 billion balance sheet, I don't know, up to three something in peak. So it was like $3 trillion, $3 trillion printed, but it took 3 or 4 years. In 2020 with COVID, they printed like 5 trillion in 18 months. So it was a lot more and a lot faster. And frankly, I think when the next break comes, and I think it's coming because we can see, the stresses in the markets, they're going to have to print more than 5. And so this is why I'm firmly in the camp of inflation is now, it's now a feature, of the system, and it's going to get worse. I think that when the bond market becomes aware of that, the bond market's going to say, oh my God, this isn't getting better, it's getting worse. I don't want to hold these 10, 20, 30-year obligations to the U.S. government. They're just losing money. They're losing value because I know what they're going to have to do. So I'm going to sell my bonds. Well, selling those bonds will make interest rates go higher. Interest rates go higher will make the budget deficit bigger. And that's the doom loop, right? And it's reflexive. So bigger deficit, more bond sales, bigger deficit. So it just goes around in a circle. So at that point in time, what I think the Fed will do is what they did when they had similar debt to GDP after World War II, at 130% then, 120 something now. The Fed will say, we are going to step in and buy the bond market. And we're not going to let rates go. We're going to fix the 10-year at 4.5, and we're going to fix the 2-year at 1. And if you want to sell them to us, feel free to sell them to us. Well, I think a big piece of the bond market is going to look at it and think that inflation is going to be higher than that, and go, great, sold to you. And so suddenly the bond. Now keep in mind the bond market, the U.S. federal government bond market is like $37 trillion. So what if a third of the bond market woke up and said sold to you? Well, there's your Fed balance sheet going from 6.7 to 17. And, a lot of that would get, it's reserves created in the systems with the banks would lend against it. That would flow into the money supply, and we'd have very high inflation. So, rinse, wash, repeat, right? And the more inflation we get, the more the bond market says, nah, I'm not holding these. I'm giving them to you, Fed. The more the Fed has to print money. I mean, this is a sovereign debt crisis. We have seen similar things in other countries. It happened in Mexico. It happened in Venezuela. It happened in Zimbabwe. It's happened multiple times in Argentina. It's happened in Brazil. I mean, we know the pattern. If you do certain things, you get certain outcomes. Now, what was the mistake or the error that a lot of people, I think, made was they thought, well, America is the biggest country, the best country, the reserve currency. It can't happen to them. Well, guess what? It might have taken a bit longer, but if you, play stupid games, win stupid prizes, right? I think we're gonna have a very similar outcome. So that's kind of how I see it.
What does the world look like 5 years after the big print?
Oh boy, I think we have a very high inflation world. I think maybe, and the reason I wrote the big print is I think that what happens is, the inflation is high, it's persistent, the economy is punk, there's a lot of civil disrest and a lot of unhappiness, sadly. A lot of people are suffering. And my hope is, my hope it doesn't even take 5 years, but my hope is that politicians emerge, the RFK types and others who realize that sound money is the issue, that the problem we have is a monetary problem. And they stand up and they say, folks, we need to go to a sound money standard, and I propose that we transition to the Bitcoin standard or to the gold standard, which wouldn't be as good, but it would be still better than fiat. And voters are like, yeah, right on. I'm tired of this inflation. Absolutely, let's do that. That's the hope. And there's some evidence that maybe that we'll get there. I mean, Scott Bessent was a gold guy. Scott Bessent last summer, the Treasury Secretary, said, hey, there's a possibility we're going to have to reset the system here monetarily. It's imbalanced, and something that would look like a Bretton Woods conference, which they held in 1944. And if that happens, I want to be at the table. So that implies to me that he's thought about it. And then I thought it was interesting this weekend. I'm not sure what he was doing, but Trump tweeted, because he's such a wild card. Trump tweeted, he who has the gold makes the rules. I'm thinking, hang on a second. Is he thinking of taking us back to the gold standard? I mean, who knows? But the point is that, to answer your question, Mason, the way out of this and the good news on the other side of this is if we return to sound money, things get better. And that's the message of the book. Sound money is a very important issue. Sound money is the core issue. It's really what's caused a lot of the problems and the dysfunction. And it's not impossible to go back to it. It's painful. It's definitely painful because there's a reordering of things. What used to be valuable isn't valuable, and what used to be cheap becomes more valuable. But once that reordering, and that caused a lot of pain for some people, but once that reordering takes place, everyone then says, oh, okay, I understand these rules. I know we've got sound money. I know this, I can't borrow cheap and invest it in things. I mean, it's a safer and better system. And so, that's what we hope to achieve. That's where we hope to go.
As Larry Lepard warns of a looming financial crisis, with bursting bubbles and economic turmoil ahead, Bitcoin stands as a potential lifeline. Lepard paints a picture of a crumbling system where excessive debt, inflation, and a collapsing stock market signal a deeper reckoning. Against this backdrop, Peter Chung of Presto Research predicts that Bitcoin could surge to $210,000 by 2025, fueled by institutional adoption and global liquidity expansion. Chung's prediction aligns with Bitcoin's growing dual nature as both a high-risk asset and a safe haven digital gold in times of financial instability. As markets falter, Bitcoin increasingly offers an escape, mimicking the protective role of gold. This sentiment is echoed by recent tweets reflecting a shift in market dynamics. Cointelegraph reported that over $500 million worth of Bitcoin was withdrawn from Coinbase, signaling a bullish sentiment and institutional accumulation, a clear sign that big players are betting on Bitcoin as a hedge against traditional assets. Furthermore, Merlin the trader highlighted Bitcoin's golden cross, a technical signal historically leading to massive price jumps. With past moves of plus 139% in 2016 and a staggering plus 2,200% in 2017, the pattern suggests Bitcoin may be primed for significant gains, potentially next stop, the moon, as the tweet states. As financial instability grows, the tweets and predictions signal that Bitcoin is not just surviving, but thriving. It's no longer just a speculative asset. It's becoming a refuge amidst the financial storm that Lepard and Chung both foresee, offering a new path to security for investors. As we wrap up, do you think the stock market is headed for a major crash, or can the Fed still kick the can down the road? Let us know your thoughts in the comments below. Share this video and hit the like button. Thanks for watching, and don't forget to subscribe.